macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen. Well, while the politicians continue to point fingers at each other over the fiscal cliff talks, stocks continue to edge lower, and the volatility in the market is spiking. And so let's take our generally bullish market timer, Kevin Cook, and ask him the obvious question: is this a buying opportunity in the market?
Very soon it will be. So we looked at this last week as, past couple of weeks actually, as a time to be cautious, because the closer we got to talks breaking down, the closer we get to the end of the year, it looks like no deal is going to happen, and that's exactly what's unfolding. But the sell-off hasn't been, swift and vicious.
Right.
It's just been steady grind down lower. Here's the S&P, and we're coming into some support areas. We're breaking a support level at 1450 on the S&P. We're breaking the 50-day moving average, but there should be some responsive buyers around 1400. Down to 1390. Last week we had that sort of mini flash crash where the S&P futures jumped down to 1390 when House Speaker Boehner had to give up his Plan B, and so the market's sort of gravitating there slowly. Let's look at some other indexes here, because I just want to show you. So the S&P looks weak. Look at the Russell. Russell's still holding up well above its 50-day moving average, and also the mid-cap 400. Looking tough, actually made new all-time highs above 1,030. This is sort of the sleeper index. And what I think is going on here is, so back up to the bloodshed in the S&P, here's where your large dividend payers are, right?
Oh, okay.
So I think you're seeing a lot of dividend selling. Russell not as effective. The Russell should lead at this time of year, typical small cap rally, and the mid caps are showing some strength. So I think this is part of the let's sell our dividend stocks now before taxes get really hiked on them.
Was this what you had envisioned for gaming the cliff?
Yeah, I like to think we've sort of played this right, but nobody can play it perfectly, and it's such a roll of the dice and a crapshoot with Washington anyway. I just think it became apparent to me the past few weeks it was a good time to be cautious. Let's not go all in now, because we're going to have these. We sort of priced in a cliff deal, and then we're tolerating no cliff deal, which is sort of strange too. So it's been hard to figure out what to make of it, except that it pays to be cautious. And if I'm still a bull, which I am, and looking for new highs, I can get on board once the uncertainty is taken away. Once we have confirmation that Washington can function and institutional players aren't going to come back from Christmas vacation and hit all the bids.
Well, speaking of the last 2 weeks, last week, in fact, in some of your commentary, you said that the Santa Claus rally had already come to town.
That's what I thought, yeah.
And I recall, going back a little further than that you had some disparaging comments about Santa hanging by his beard from the fiscal cliff.
Well, yeah, and we did get a rally higher than I thought, up to S&P 1440, but apparently he is and was hanging by his beard from the cliff. Now, when people talk about the Santa Claus rally, we tend to think, oh, this is something that happens, into Thanksgiving and all the way up to Christmas. But, the Stock Traders Almanac, Yale Hirsch and Judd Hirsch, they've been around forever. I don't know if it's Jeff or Judd, but anyway,
one of them.
Young man Hirsch, he is, carrying on the tradition. They look at these historical tendencies. He says the Santa Claus rally is actually the last 5 trading days of the year and the first 2 trading days of January.
Oh.
So that 7 days, he says, in the statistics that they study, that's where you're looking for what is the Santa Claus rally, and they look for 1.5%. Now, if we don't get it in those 7 days, that's a bad omen for the markets, is what he says.
So, we could see some selling into the first few days of January.
Yeah, we're 3 days into this 7 days, and it's all been selling. So unless they come out and announce some kind of deal that pops the market,
right.
It's not looking good.
All right, so we haven't talked about the volatility yet. Let's turn our attention to that.
Yeah.
I know you've got some charts too.
Yeah, I always want to take a look. The VIX here spiking. What's interesting is that I said that this sell-off in the S&P has been sort of a slow grind downwards. Meanwhile, the VIX has been moving up pretty rapidly. So what that tells you is big players have been buying protection. They've been buying puts, and they're not, a lot of big players are on vacation, on holiday, right? They're not here actively selling.
Right.
They're sort of in wait and see mode, but at the same time, they're like, let's buy some puts. Let's buy some insurance for the downside here. And that's why you see the VIX over 20. Yesterday, when it closed above 19.5, that's the highest we've seen since July. So you can call this fear, or you can just call it lots of insurance buying, even though stocks are not falling off the cliff yet. I want to show you one more interesting study here of volatility. An option trader, associate of mine, he compares the VIX, which is the volatility index on the S&P 500, against the RVX, which is the volatility index for the Russell 2000.
Okay.
Now, there's not a lot of fear in that, but what he does is you take the VIX and you subtract RVX. And the VIX tends to be underneath the RVX. So let's say the RVX is trading at 22 and the VIX is trading at 20. So that's -2. What he's showing here on this longer term chart is those times where the spread got very close, where the difference between the VIX and the RVX got very tight, meaning the VIX is rallying up to the RVX, were times of great fear and a market sell-off. So he's pointing out these times, 2010 flash crash and the Euro debacle, the debt ceiling debacle of 2011. Look where we are. The fiscal cliff is back up at those levels of a smaller than 2-point spread between the VIX and the RVX. So this is a volatility relationship you want to pay attention to, indicating that fear is on the rise, could also portend a bigger sell-off.
Okay, well, you can read Kevin's analysis and commentary on our website, Zacks.com. If you're not there already watching this video, he comes up with some pretty interesting stuff. Check back often because it changes from time to time. With Kevin, I'm Terry Ruffalo.